Let's talk about just how important it is for an economist like yourself to finally get access to the data. And by the way, which pieces of data are the most important to you?
That's very important, Dom, because if you think about it, exactly as Emily just said, we did not have anyone collecting data in October. So we will most likely not get inflation for October. We'll most likely not get employment for October. And if we begin to think about the non-farm payrolls data, meaning what's happening for November, well, we normally have that the data for employment is collected in the week of the 12th, which happened to be exactly this week now. And now government workers will get back to work only starting the middle of next week. And then they start to, of course, begin to collect the data. But then we're getting closer almost to Thanksgiving. So this is also raising questions about if we do get November employment data, what is the quality of that data if it's now collected closer to a Thanksgiving week? So there's all kinds of challenges for markets in terms of what is exactly the health of the economy, especially when it comes to the public data from the government, because we may not get the November data in a way that looks similar to what is comparable for how we normally think about the employment report. And finally, other indicators, as you mentioned, Dom, they have been showing a labor market that's still okay. If you look at Revilio Labs, has an indicator for total non-farm payrolls, that's actually been going up. If you look at jobless claims, if you add up the nationwide data for the 50 states, has actually also still been very low, meaning very few people are getting laid off. Also, yes, there were some small issues with Challenger and Gray and Christmas. Also, the macro edge data was also slightly worse. But the big picture, when you look at across the board, also the indicators that are coming from other sources, it still tells you a labor market that's actually still doing okay. So the bottom line to your question is that the economy is likely still doing fine. But the key issue here really is it may still take probably another month before we get a real look at where is the economy at the moment.
Torsten, how exactly as an economist do you work through some of those issues, those hurdles you just mentioned? How exactly then do you kind of adjust your workflow, your models, your methodology for kind of this transition period, if you want to call it that, for kind of getting out of this government shutdown data, at least whole, into one where we are getting maybe increasingly better quality data as the months go by?
Yeah, this is also a very important question because as we will go through the next several weeks, we will get data that's gradually better and better. But at this point where we sit right now, it still is very foggy when you think about what is actually the health of the U.S. economy at the moment. We have an idea from ADP about the labor market being in relatively good shape. And we also have some idea from a range of other indicators. We have Indeed job postings. We also have link-up job postings. All those things continue to signal that things are okay. But the process, the assembly line of the data that comes through on my desk in terms of what do I look at has really widened dramatically simply because I didn't have what I normally spend most of my time on, namely what comes out from the BLS, CPI, and non-farm payrolls.
And Torsten, before we let you go, there's been a big argument made and maybe almost consensus at this point amongst economists that we speak to on our air here at CNBC that the maybe bigger risk to the economy in the coming months and quarters is tilted more towards the labor weakness side of the argument as opposed to the higher inflation side of things. I wonder, given what you know right now, is that the right view to take, or is inflation still an issue?
Well, this is exactly why the discussion at the moment. So let's just agree that the data so far is okay on the labor market. But this brings us back to the discussion we had before the shutdown, namely, why is it that job growth has been slowing down in the last 6 months? Is that because immigration is slowing? And I think that it is because immigration is slowing. So in other words, it is simply because labor supply has gradually been coming down. There are simply fewer people coming into the country. It used to be the case over the last several years that non-farm payrolls was 200,000. Now the Fed just published a paper saying we should expect job growth over the next 12 months to be 30,000. So a dramatic decline in the equilibrium rate of job growth simply because of immigration slowing. So the key issue here to your question, Dom, it is probably not so much labor demand slowing, it's really more labor supply that's slowing. And this has very important consequences for the Federal Reserve because there's nothing the Fed can do about labor supply. If it were labor demand, then the Fed could do something about it. So that's why this debate is now coming back as we get more clarity about where exactly are we on the labor market at the moment.